Okay. So the reason I created this lecture, and now it's actually more than a lecture, it used to be one giant long lecture, and I've decided to break it up into actually now 4 parts. So we'll do like a weekly series, and this is going to be the first part. But it's pretty clear that as physicians, we have very little training in financial planning, personal financial planning. And you hear even today, I just heard people talking about all their stock picks and shorting and options, and I was like, well, that's nice and all. It's fun to learn that, but that's not really what your financial plan. Which of you are doing options?
I dabble.
You dabble. I knew it, Corey. And so, they did a survey. This caught my eye a couple of years ago, and they talked about how orthopedic surgery residents lack financial know-how. But I would argue, here comes a technical glitch. I would argue that it's almost all residents lack any financial know-how, despite your huge debt. And on top of that, you all start we all started about a decade later than most people who are earning, right? So we start our physician incomes in our 30s. So that's an even more of a disadvantage on top of the huge debt that we carry, a lot of us. So I created this series, Basic Financial Planning for Young Physicians. So here's my young physician here. And it's never too early to start, right? So I think actually I'm going to start giving this talk to the medical students as well, because I think that's probably the ideal time to process a lot of this information. But I hope that, like my daughter, by the end of this lecture, you guys are not passed out like this. So you guys are all, your video is off and you're muted, so I can't even tell. You could be sleeping for all I know. You physicians are highly educated in how to care for patients, but often have little to no education or even interest, honestly. I mean, there's so many residents and even attendings that I talk to who are like, I don't want to learn this. I don't want to know it. Just tell me what I have to do or who I should speak to help me, make my plan or manage this. And for a while, you didn't have to deal with the issue of how to create a financial plan and what to save and invest in, because you never had any money left over anyway from your paycheck. So, but soon you will be attendings, and even as residents, you all make $50,000 to $60,000, and guess what? That's what the average American family makes, right? So, you need to have the plan in place, even as residents. Doctors will not become rich just from income, but they can become wealthy and live a comfortable life with proper financial planning. And the other key thing is that, without a proper financial plan, one of the main reasons for physician burnout is financial stress and being forced to practice medicine in a way that you don't want to because of the way you built your financial life and being dependent on that paycheck and income. And so if you have financial security, or even better, financial independence, which is what we're striving for, then you can practice the way that you want to, as opposed to the way that you're forced to, right? And that's really key. A couple of good books that I often recommend. White Coat Investor has become more and more popular and has become sort of a name amongst young physicians and residents. When I first heard of him, I think he started his blog in like 2011, and I kind of ran across him in 2013. And, I started giving this lecture about 2015 or so. And he has an excellent primer on more in-depth information of what to do and how to approach your financial plan, which will springboard off of the lecture that I'm giving now. So if you know nothing at all, the boot camp book is excellent if you just want an algorithm where it's like, okay, step 1, 2, 3, all the way to step 12 of laying out a pretty good solid plan. This was his original book, the White Coat Investor book, the one in the middle. And this is a book written by a bunch of financial planners called Doctor's Eyes Only, which is also an excellent book. So if you have, I have a couple of copies of this, so if anybody wants a copy, I can give it out to you guys. So some disclaimers: I have no formal training in financial planning. The advisors that I currently use actually wrote that book, the Doctor's Eyes Only book. And some of the details I present may change over time, predominantly like the tax code limits and some of the legal stuff. And finally, the purpose of the lecture, even those books that I showed you, is not to have like an algorithm that you follow. It's to educate you on the sort of the important issues to think about and the many different options that you have at your disposal, so that you can learn what's the appropriate plan for yourself, for your situation. You know, one size does not fit all. And it's why it's called personal finance, right? So because it's very personal. So over the next 4 weeks, we'll talk about these main topics here. So today is predominantly going to be about financial risk management. Part 2 will be talking about cash flow, debt management, creating a savings habit, and really money and happiness. And part 3 and 4 I used to give together, but part 3 is about talking about taxes, which I think are your biggest obstacle to financial independence, and how you can uh, minimize the amount of taxes. And finally, part 4 is the portfolio creation and some investing basics. When I talk about personal finance and financial planning, people often think of the last part, the portfolio creation, as, okay, what stock do I buy, or what are, so Corey will help you learn about options and some of that stock related stuff, but that's not really the important stuff. See, as you can see, that's all the way at the bottom. Trying to get a good rate of return, as you'll hear about in part 2, is probably the least important thing for you guys right now. And so any questions along the way, feel stop and interrupt me. I don't mind. So I like this slide a lot because it talks about, kind of the foundations of your financial plan, and the main foundation, the base of this pyramid is risk management, right? So what are the big risks to your financial career, right? Your financial life. And a lot of that has to do with insurances, right? And as I learned about this stuff, my philosophy and goals with insurance changed significantly. And we're going to talk a bunch about insurances today. I used to think, the Geico commercials, right? So 15-minute call can save you 15%, right? And my goal before I really learned this stuff was, how do I pay the least amount for insurance? Like, what's the minimums that I have to do to be covered legally, right? Particularly with car insurance. But as you start creating a net worth, and as you start your earning potential, insurance is really there to protect you against losing that net worth or losing your earning potential, as we talk about with disability insurance. We're also going to talk about creating an emergency cash fund, some basic debt management, estate planning. Then the next step is capital accumulation. So accumulating capital for the various sort of near-term goals that you have. Then wealth accumulation, how to create portfolios that will create that wealth and increase that net worth. And finally, the last thing is the aggressive investments, right? So these are your stock options, Bitcoin. So I have Bitcoin, so I dabble in all this stuff as well, right? So, but this is the stuff that you should put the least amount of attention on and focus on everything down here, right? So, I give this lecture every year, and every year I'll ask, okay, so did you get your disability insurance? And nope. Corey, do you have disability insurance?
Nope.
I'm going to pick on you.
That's fair.
So see, you're spending your time up here, right? But you have to work on your foundation, right? So, and that's why I give the lecture, because to sort of reorient you guys to, what's going to be important, what's going to be the most successful path forward, right? To increase that net worth and get that financial independence earlier. So risk management, right? Emergency fund. So what is an emergency fund, right? So some of this stuff might sound really basic, but it always surprises me the number of people who don't understand about disability insurance, emergency funds, or some of the tax stuff that we'll talk about later. So in general, your emergency fund, you want to have 3 to 6 months worth of liquid assets that can cover your usual monthly expenses for that phase of your life. So as a resident, you're hopefully we're going to have lower monthly expenses compared to even as an attending. So this emergency fund is going to change as well. It's not just one-time bank account that you just set aside, right? And the idea of this is that if you had zero income, if you, your spouse, family had zero income at all, then could you pay your bills for the next 3 to 6 months until some of the other sources of income kicked in, like your disability insurance or whatever other insurances that you need to cover you or getting a new job, for example. And so why the 3 to 6 months? So long-term disability insurance usually kicks in after 90 days or 3 months. So if you do have a disability, for example, then you need to be covered in that short-term period until that insurance kicks in. If you quit your job and go to find a new job, you don't go from paycheck 1 to paycheck 2 like immediately. Usually there's kind of a lag. So you need to be able to cover expenses. Plus, finding a new job, changing a job, or moving, or they're very expensive, right? So not only do you have your usual customary expenses, you might have a lot more transitional expenses as well. So very important to have that emergency fund for those reasons as well. I've told you, a couple of you guys, my story of when I finished fellowship and then became an attending. I was supposed to start, I finished fellowship June 30th. I was supposed to start work at July 1st. I didn't get my medical license until like end of August, and I didn't start working until September. So I had no income for like 2.5 months. And while it was fun having, being on vacation, it lasted for about 2 weeks until we ran out of money, and I, had to borrow money to pay rent. So definitely learned all about all this stuff after the fact. Large unexpected bills might arise that you need that emergency fund for. And in an emergency, you can use some of your retirement accounts, particularly things like Roth IRAs that we'll talk about later, to cover any kind of emergencies. But in general, you don't really want to touch your growth funds, your growth accounts, because if you take money out of there, then it's going to be less compounding, and it's going to sort of delay your progress to that financial independence goal. So, any questions about emergency fund? Okay. And so with how do you calculate 3 to 6 months? Well, it's simple. You guys know your income, and you if you sit down and look over all of your expenses, look at your fixed and dynamic expenses for an average 3-month period, and make that a goal to set aside that money for that period. Insurance. So as I mentioned earlier, right? So insurance protects yourself and your family from financial catastrophe, and that's the way to think about it. It's not just, okay, this is the minimum amount that I need. And as your finances, as your net worth increases, your insurance needs will also change and potentially increase as well. Insure against big hits. So these are things that you cannot sustain financially, right? So a big lawsuit, for example, or even like our home, my home flooded, and it ended up costing tens of thousands of dollars, but insurance covered it as well. So these are things that you want to insure against, the big hits, but self-insure against the small hits, right? So how do you do that? You have high deductibles, and you have your emergency fund to cover those deductibles, right? So as an example, you wouldn't want a $0 or $100 deductible, but only have $100,000 of liability on your car insurance as a physician, right? usually in my case, for example, I have $1,000 deductible and $500,000 personal liability. Why? Because it's about the same cost for both, actually. So the higher deductibles offset the higher liability coverage. So if you have an accident and somebody gets out of the car and they grab their neck and say, "Oh, this person has MD plates," this is where you need that higher personal liability protection. So that's a key thing about insurance, right? So that's something that's shifted for me as I've given this lecture over the years and also gained more in my net worth, is to use insurance to protect you against financial catastrophe. Not necessarily don't go for the cheapest insurance, go for the appropriate amount of coverage. Disability insurance. So, what is your only financial asset right now for most of you? Anyone? So it's your ability to earn lots of money. Right, Marie? I think you're my ringer, so.
Yeah, I was gonna say my husband's watching too, so he said the same thing.
Yeah, very good. Excellent. So it's your ability to earn lots of money for the next 2, 3, 4, even 5 decades, depending on how long you want to work, right? That's it, right? I mean, most of you have no net worth. You're worthless, right? Meaning you're worth less than zero, right? Because of all the debt and debt burdens that you carry. So how do you protect that asset of that ability to earn lots of money? And that's through disability insurance, right? Life insurance takes care of your family, but disability insurance only takes care of you. Disability insurance takes care of you and your family in the event of a disability. And how often does this happen? So it's estimated that 1 in 7 docs will have some disability in their life, right? And in fact, if you look at the Social Security Administration puts out their numbers, and they say 1 in 4 Americans over their whole lives will claim Social Security disability at some point in their lives, right? So this is not as uncommon as you think it is. So it can definitely affect your career and your ability to earn a living. So there's 2 major types of disability insurance, right? So there's short-term disability and long-term. So long-term disability covers you after 90 days after a disability occurs. And this varies. So you can have it as short as 30 days, or I think I know of someone who has 365 days, a whole year, that they have to be disabled for the long-term policy to kick in. Obviously, the shorter the term, the more expensive the policy is, and the longer the term, the cheaper the policy becomes. But usually most people will opt for a 90-day period because if you have a disability, how do you survive those 90 days? Your emergency fund, right?
Emergency fund.
There you go. There's my ringer. And so short-term disability is so this is like, say, you go out hiking and you twist your ankle or something and you can't work for 3 weeks, or you break a bone or something like that. And so that means that from that day on that you can't earn your income until a certain period of time, usually up to 90 days as well, then you will have short-term, you'll have insurance payout for your disability. Now, the problem with this, it sounds great in theory, right? But the problem with it is often it's very expensive for very little coverage, right? So, and it's unnecessary if you have an adequate emergency fund, right? The likelihood of you having a short-term disability is pretty high. And so that's why it's very expensive, right? But the likelihood of you having a long-term disability is medium. And so it tends to have a sort of a medium level premium. For reference, I think, so some of you have been getting quotes recently. I think something like $5,000 a month of disability coverage is costing, I don't know, $100, $200, I guess, depending on your health status and all that. So I've heard quotes of around $150, even up to $200. So, so it's not cheap, and I get it, and we'll talk about why I think you should get it as soon as possible. When should you get disability insurance? As soon as possible. Lock in your good health now. So I've had residents who've had developed migraines. I have a resident who developed Lyme disease during their residency. I've had a resident who was like perfectly healthy, but then got rear-ended and then had low back pain issue. And so guess what happens when this stuff gets on your record? Your disability premium doubles, triples, goes through the roof. Sometimes you're actually even uninsurable, depending on, like, if you have any kind of long-term issue, any kind of long-term symptoms or pathology, then a lot of times companies won't even insure you. And so you're kind of, you're out of luck. So the sooner you lock in your good health status, the better it is. And not only that, it also puts you in the better premium class, so that even if you develop something later on, like when I got my disability insurance, I didn't have hypertension and high cholesterol, right? So, but it didn't matter because I locked in my health status early on. And when I wanted to increase my premiums, my policy, it was based on the health status at the time that I opened the account, right? So some people will say, my employer gives me a policy, so why do I really need it? Well, the problem is you might not be with that employer forever. If you change jobs, guess what? That policy just disappeared, and now you're at the mercy of your new employer. Not only that, even if your employer has a great policy, 10 years down the road, they might say, you know what, this is getting too expensive. We're going to get rid of it or change it, or make it something that's not as good. And so you're at the mercy of that employer again. And so but if you open a personal policy, that follows you wherever you go. As long as you pay the premiums, you're not going to lose that policy. Any questions about this?
Question, sorry. So would you take both your employer policy and have a personal one?
Good question. So, and we'll talk about that. So usually you can kind of stack them together to meet your goals, knowing that if you lost your employer policy, then you're only going to get whatever personal. For example, for me, I have a personal policy of $13,500 a month, and Napa, my employer, has a group policy of $10,000 a month. So that's $23,000 a month potentially of disability benefit. So I think it would be excessive for me to get a personal policy of $20,000 and then on top of that have $10,000 on top of that, right? So it depends on sort of the job that you take, and because at that point you'll be working your first job when you jump up your personal policy to what you think is the appropriate premium. And for the most part, I've seen most of the big employers are giving about $10,000 a month of disability policy. So that's just a general guide. 5,000 to 10,000, I would say, is what probably your employer is going to give you, if they give you anything at all. So, but the way you structure your personal policy, you can increase it to whatever you want. So as long as you meet the limits, and we're going to talk about that in another slide or two. So how much should I get? I can't afford it. $200 a month is not an insignificant amount of money for a resident, right? So start with as much as you can afford. Usually, I think the minimum these days starts at $5,000 a month. And as I said, it's about $100 to $200. And you're going to get what's called a future increase rider, which basically means that you're locking in your health status so that when you become an attending and 2 years from now, a year or 2, 3 years from now, you can increase it from that 5,000 a month to 10,000 a month or 15,000 a month or whatever it is, with that same level, that same health status, that same premium class. How much do they let you insure? It's usually up to 60% of your income, or a hard cap. The hard cap is usually $25,000 per month. And that's combined with your employer amount. So if you have a personal policy in place already, let's say you have a personal policy for $20,000 and your employer says, oh, we give a $10,000 policy. If you have that personal policy in place first, then now you have $30,000 of coverage. You can exceed that cap. But if your employer is going to give you $10,000 policy, when you open that personal policy, they'll ask you, do you have any other policies already? And you have to declare it. By the way, with insurances, you never want to lie, or you never want to fudge anything, because if they trace it back, which they 100% will try to, if they have to pay out a claim, then they can deny you the claim, saying, hey, you didn't represent things appropriately, right? And so the worst thing to do is to pay for all this insurance and then not have it when you need it. So you always want to be upfront about everything. Now, that being said, you don't want to be upfront about everything directly with an insurer when you open it. It's better to go through an agent who can tell you about what's appropriate and what's not appropriate, because sometimes that can mess up your ability to be insured as well. So if you have a good agent, and I can give you guys some recommendations of good agents, then they can kind of coach you and guide you through, what's appropriate, because that's all they do, is they do policies and they do claims as well. So is the benefit taxable income or tax-free? Your personal policy, because it's paid with post-tax money, will be tax-free. Your group policy may or may not be tax-free. You may have to pay a tax. I may have to pay a tax on that $10,000 that NAPA will give through their disability provider. Question? Okay. So I think, this is the question that you were asking, Corey, I think. So how much should I get? So the net income desired if I'm disabled. So that based on your budget that you're going to create of what your monthly expenses are, and subtract out the group benefits available and any taxes owed on either of those policies. And that's the required disability insurance, right? Now, the other thing about disability insurance is that it's expensive, right? So I pay $400 something a month for that $13,500 of disability coverage. So, that's $5,000 a year that goes towards my disability insurance, right? And so it's expensive. It's it's $5,000. It's like a not insignificant amount of money. And eventually, I'll have enough assets that I won't need to pay those premiums anymore, because if you become financially independent and you become disabled, what would you do? Just retire, right? So you don't need that insurance. You don't need to keep paying out that money for something that you don't need, right? So that's what I mean about constantly needing to readjust insurances as well, based on where you are in your financial path. What are some important clauses to look for in the disability insurance plan? So usually the most important thing that people obsess about is the definition of disability, right? And so there's something called own occupation, and even within own occupation, there's different tiers of this, right? So the best is specialty specific, right? Meaning, like, as an anesthesiologist, if I have an injury and I can't intubate anymore, and that means that no matter what, I'm going to get paid out my disability policy. It doesn't matter if I can, go to PAT clinic and see patients, or become a radiologist or an internist, or even change careers completely and make even more money in another career, because I couldn't do that specific specialty. If you have that clause in your policy, and of course it costs more money to have this clause, then you will get paid your disability premium. So there's two things, right? There's total disability and there's partial disability. If you're totally disabled, it's black and white, right? So you can't work at all in any capacity. Then it's a no-brainer. Like, even usually, except for the worst of the worst policies, they'll pay out. But partial disability is where the issues arise, right? So you have an injury, musculoskeletal injury, tremor, whatever, even psychiatric issue, they'll pay out. Now, psychiatric issues usually only pay for up to 2 years I think that's the maximum that pretty much all the policies pay. But anything else beyond that, any sort of health related issues beyond mental health, will pay indefinitely till the term of your policy. And usually that's 60 or 65 years of age. Non-cancelable or guaranteed renewable. Basically, it means that as long as I keep paying my premiums, they can't take away my policy, that they'll always be there as long as the company's in business. So obviously that means that you want a reputable company that's been around forever and will be around forever. The slight difference between the two, it's not that important, but you want either non-cancelable or guaranteed renewable. Future increase benefit, right? So this is the benefit of locking in your health premium, so to allow you to increase coverage each year if you wanted to. Usually it's once a year they allow you to increase your coverage, and you have to send them either your W-2 or your paychecks to show what your salary is for that year. So generally for residents, I'll tell them towards when they start their attending job at the second half of the year, that that's one point where they can increase, or actually if they make you wait for the tax return, when you file your tax returns the following year, you can increase it up to a certain amount, because they only pay 60% of your gross income, right? I mean, they only let you take out a policy up to 60% of your gross income per month. And then the year after that, you increase it again to what's appropriate for you as an attending. Often these policies have exclusions for high-risk activities. I know snorkeling has been asked. So you just have to look through the fine print. And if that's something that you do, like that's something that you really want to do, you have to talk to the agent to say, like, these are some of the things that I like to do. If I have a disability related to some of these activities, and will it cover me or not? And you have to kind of think about that. Like I told the example of me, I was getting laser surgery for basically LASIK surgery. And I actually called my agent. I said, if something happens, because I delayed LASIK surgery for decades, literally, because I was always afraid, like, something happens to my eyes, right? And you always hear, being in medicine, we always hear like the worst outcomes, right? The horror stories, when 99.9% of people are fine. And you're like, yeah, you're covered. So just to show you the kind of how crazy some of these policies can be about their exclusion. I mean, if you ever look at the disability policies, they're like 50, 60 pages long, so there's a lot of fine print to sift through. And as I said earlier, eventually you have enough accumulated assets that you won't need disability insurance anymore anyway. Any questions about disability insurance? I can't believe I explained it that well that nobody has any questions about this stuff. All right. Very good. So if you have any questions at the end as well, you can save them, or if you want to ask me in person, that's fine. Life insurance. So, who should have life insurance? Basically, it's essential if you have others relying on your income. If you're married, you should have some kind of policy, I think. If you have kids, you definitely need to have a policy, right? Because again, your family is banking on your decades of earning a high income. And if something happens to you, it's gone, right? So now your family needs to restructure their whole financial plan, right? So unless you have appropriate life insurance coverage. So how much life insurance do you need? How much does your family need? I guess you don't need any. How much does your family need? Is $1 million replaces every $1 million replaces $40,000 to $50,000 per year in annual income. And where does this come from? It's assuming that you get a 4 to 5% rate of return, which is a pretty conservative rate of return. And so that's about what it takes. So if you had even no rate of return and you just took out 3%, and that'll last you, what is the math? About 20 years, right? So, but in general, the way to think about insurance and even investing, as you'll see later on, each $1 million gets you $40,000 to $50,000 of annual income. The other thing to think about is, the type of debt that you may have. So state laws determine which debt is forgivable. So you may have to potentially insure these debts as well, right? So if you consolidate your loans, sometimes, your family may become guarantors for your loans as well. So that's potentially a big chunk of money that you're going to have to pay out. There's two types of life insurance. There's term life and there's permanent, often referred to as whole life. So for pretty much for everyone universally, unless you really have some crazy complicated plan, you should never get whole life insurance. Term life basically means that you pay a premium, and if something happens to you, you die, your family gets that amount that you paid for. Whole life insurance is something that you'll hear often. It'll be someone who'd buy you lunch, and I know you guys have had this experience over the last couple of years of someone who tried to sell you whole life insurance, and what they'll try to bill it as, if you pay term life insurance and you don't die, you lost that money, right? But with whole life, you can keep paying, and not only will you have that death benefit, but we can invest that money for you, and you can start accumulating money. So the death benefit will increase, but later on, you could actually have a cash value that you can take money out of that whole life. So it's kind of like a savings account, like our investing account. And they'll give you something like, oh, we will give you a 6% rate of return or an 8% rate of return on your money. And you think, wow, this is a great deal, because I can protect my family and I can invest at the same time. It sounds too good to be true, and that's because it is too good to be true, right? So, why was he buying you guys pizza lunches all the time? Because number one, a point I didn't raise about disability insurance, but all insurance products, the salesperson gets a commission. Okay, so if you didn't know that, I'm telling you now. Every time you buy insurance, the person who sold that insurance to you gets money. And in the setting of whole life insurance and even disability insurance, they get a lot of money, right? So pretty much almost the entire first year's premiums that you pay go to the salesperson. So they have a strong motivation to sell you these policies, right? Now, disability insurance is something that probably not every single person, not every American needs, but high income earners is something that you do need, right? And so it's okay. I don't mind paying a commission to that salesperson, because you can't buy it directly from the insurance companies. You have to buy it through an agent, because they don't want to deal with selling their policies. They just have these independent agents who sell these policies. So as long as that agent is representing me well, I don't mind giving them that commission, right? Whole life doesn't really serve that purpose of protecting your family and investing, right? So if you guys, does anybody want me to go into that in more detail, or you just take my word for it? Any questions about that? Marie, what do you think? Do you think it would be useful to go over the example that I showed you?
I mean, I trust you. We're gonna get life insurance.
Is it definitely not a good idea? Sorry. Is it definitely not a good idea? Because the way you described it sounds like a good idea. So what's like I don't know,
you mean
reason why it's bad?
Really quickly, breakdown.
Yeah, okay, sure.
Just real quick.
Okay, sure. So why don't I go over it, right?
Yeah.
And so the only time, so I'll tell you, the only time you would potentially think about whole life or any of these life policies, like I have a VUL, a variable universal life policy, and I'm like, I kind of wish I hadn't gotten it, but it's okay. It's not the end of the world that I have it. The only time that it's useful is if you are saving lots of money, and you expect to have a high net worth, and you want to have some tax-free money in retirement, right? Or to pass on to your kids. That's about it. So it's not. So let me give you a breakdown of why it's different, right? So let's say you can get a $200 policy. You guys can see what I'm writing, right? Okay.
Yes.
And, okay, so you have two options, right? You can get term life policy, term life, or whole life. Now, the term life policy might cost you $50. Okay, I'm just making up numbers to keep it simple, right? And the whole life salesman will say, you know what? It's going to be $200, but you're not losing the $200. We're going to invest that money for you, right? For that same term policy of $50. But with the leftover $150, you can invest that on your own, right? And you can get a certain rate of return based on how you invest that $150. The whole life salesman makes it sound like you're investing all $200, but that's not true. That $200 has a, possibly a $60 premium to cover the term life insurance because there's a cost to insuring your life. Then he's going to take maybe, let's say, like $100 commission, right? And what's left over is the $40 is being invested, getting that 6% or 8% return or whatever they promised you, right? So it makes it sound, they never tell you, if you ask them, what percentage of my premium is actually earning that rate of return? And I don't know. I've never asked anyone this, and I probably should but I don't have the energy to deal with these people. So that's the key point here. So you're not earning 6% on $200. You're earning 6% on $40. And in what you could have done is, what you could have done is just bought your premium for what it's needed for, and then just invest the rest the way that you want. Make sense?
Yeah.
Okay. And so, but that 4%, so the game is that, why would you potentially ever want this? The game is that potentially after enough time, that money that you've invested becomes what they call a cash value. And that cash value, you can actually take a loan against that whole life policy. And that loan could be tax-free or interest-free, or the premiums that you earn on that loan that you take might pay for the interest. So in essence, it's basically like a tax-free loan. So they'll sell it to you as this is a way for you to get tax-free income in retirement, for example. Now, you have to kind of do the math and see, are the taxes worse, or is all the commissions and premiums that I'm paying worse? What's the math? And you can do the math. It's based on a lot of assumptions, and it's like a very certain way. Like you'd have to commit to this plan for 20 or 30 years to potentially break ahead. So, but in general, for somebody like for all of you guys, you should not be thinking of whole life insurance. You should only be thinking of this kind of product if you've done everything else I'm going to talk to you about over the next couple of weeks. Okay, so term life is what you should stick with. And if somebody tries to sell you whole life, run the other way, right? I think you all know about your colleague who got suckered into buying it, right? So malpractice insurance, right? So obviously it's something that you need to know a little bit about. So malpractice is, if you get sued, right? So there's two types of malpractice insurance. There's occurrence-based and then claims-made. So occurrence-based means that if you have a lawsuit against you, covers against any claims that occur while you have the policy now and in the future. And why is this important? So let's say you worked for a group in New Jersey, and you have an occurrence-based policy, and you leave that group and you move to Florida, right? And 2 years later, somebody sues you for something that you did in New Jersey, right? And so there's a statute of limitations. It varies by state. I think New Jersey's 2.5 years. Virginia and North Carolina, it's like up to 10 years. So somebody could sue you for something 10 years after you've taken care of them, right? And so you can imagine the insurance coverage costs for in those states, right? Now, the more common other policies that you'll see is something called claims made, which basically means that you're only covered during that time that you're paying those premiums. So there's no coverage after you stop paying the premiums or after you lose the policy. And so a lot of jobs nowadays, unfortunately, are giving claims made policies. And the reason they do that is because it's cheaper. So it's a savings cost to them. And so how do you get around that? Well, when you leave that job, you can potentially purchase a tail policy, a tail coverage policy. And all that does is it converts the claims made policy into an occurrence-based policy. Okay, but these are not cheap. It could be, depending on the state and the statute of limitations, it could be anywhere $5,000 to $20,000, $30,000 to get that tail coverage. So it's something to look at when you start looking for jobs. is what kind of malpractice insurance do they provide? Questions? And usually these groups will give you whatever the state minimums are, the 1 in 3 million. Okay. So the next type of insurance is your personal liability, right? So home and auto insurance, right? So physicians, as physicians, you're targets for lawsuits, right? So buy as much liability coverage as you can afford and as is appropriate for your net worth. And you can offset your high deductibles. You can offset your high coverage limits with higher deductibles to make the policies cheaper. You should definitely have an umbrella policy, right? So for those of you who don't know basically how an umbrella policy works. So for example, I have an auto policy and a homeowner's policy. The auto policy and homeowner's policy have deductibles of $1,000 up to a liability. This is in this example, liability coverage of up to $300,000. Then you can purchase an umbrella policy that kicks in after $300,000 up to $1, $2, $3 million, whatever, however much you think is appropriate. And usually this umbrella policy is very cheap for millions of dollars of coverage, because the likelihood of you ever needing to dip into that umbrella coverage is pretty low. So that's why it's pretty cheap. But if you do have to dip into it, then you're protected, right? And so it's like a no-brainer because of the cost. Your estate as well as future earnings are at risk. So if somebody sues you beyond your policy limits, then potentially any future paychecks could be garnished by the lawsuit as well. If somebody trips and breaks their leg on your home property, then they could sue you, right? Because you provided an unsafe environment in your own home for them. So that's how some of these things work, right? And that's why, if you check to make sure anybody who works on your home is insured, right, and bonded. That's what all that means. That basically, if something happens, then they go through their own insurance as opposed to your insurance. Question about personal liability? Okay. So the key takeaways from this risk management section, right? So I want you all to secure appropriate disability insurance. And as I said, if you are looking for an agent who is, I have a number of different agents that I can refer to you. But definitely you want to lock in your good health status as soon as possible. And you can have creative ways to structure it so that you can pay the least amount that you want to pay now, and increase the coverage appropriately when you're attending. Unfortunately, I think you guys got a blast text or email towards the end of last year. One of the things is for females is that the disability insurance tends to be more expensive because of the potential risks of pregnancy. And a lot of the big insurance companies, there's 5 big insurance companies that have good definitions of disability for physicians. And they used to have unisex rates, so rates that didn't matter whether you're male or female. But the unisex rates are being phased out, and I think it's Mass Mutual is the only one that's left, and they just decided to end a certain premium level at the end of last year. So it's become more expensive as of this year for females. So the other thing is that if there's a big group of you who are interested in doing this all at once, then oftentimes the agents can negotiate sort of group discounts with these companies. So I know that past classes have done that, where they've had a group of residents sort of all sign on together at the same time. So that's something that I can help facilitate for you guys as well. So also secure and adjust your current insurance policies, like your life insurance coverages. Same thing with life insurance, lock in your health now. I didn't talk about laddering your life insurance policies, right? So you can have, how long do you need your life insurance to be covered for? And if that's something you're interested in, then I can talk about it more in the Q&A or privately if you'd like. And finally, start kind of getting a hold of what your expenses are and think about how much of an emergency fund you need to accumulate, and realize that, again, this emergency fund is something that's going to be changing based on the changes in your expenses as well. So I think that's it for part one. How did I do for time? About an hour.
Dr. Nandigam, can you talk more about laddering your life insurance?
Yeah. So for example, like I have like $4 million of life insurance, right? So if something happens to me, basically, it would see my family through. I would expect to have about at least $4 million in retirement, right? Is my personal financial goal. So I could just take out a $4 million policy until the age where I expect to achieve financial independence, right? Well, so let's just say, I expect to be financially independent in my 50s, but let's say 60, just to keep the numbers simple, right? And so say you're a 30-year-old new grad, so that would be a 30-year policy. So that's very expensive, right? To have 30 years worth of $4 million of coverage. Now, what I could do is that I expect that 10 years out after becoming attending, I should have about $1 million of net worth. And then 20 years out, I should have probably maybe $2 to $3 million of net worth or more, right? And then at 30 years, I should have $4 million, right? So what you can do is you can have a policy like so for the first, 1 million, then let's say 3 million, and then 4 million will be my net worth, right? So you can have policies. So I can have $1 million policy that expires in 30 years. Right? And then I could have, let's say, a $2 million policy that expires in 20 years. And then finally, I can have, like, let's say well, we'll just keep it simple, and we could have a $4 million policy that expires in 10 years. I probably would say like a $3 million policy, for example. No, I did the math wrong. Hold on a second. 1, 2, and 2. Okay. Did I do it right? But you get the idea. The idea is that you will always have $4 million of coverage for 30 years. But as you hit your net worth goal, then some of this money will disappear. Does that make sense? Did I explain it well?
Yeah, it does. Thank you.
Okay. So yeah, so by laddering, you can actually save money by not having a giant policy last for 30 years. You can have smaller policies that add up to your target that expire as you hit your milestone goals. Okay.
Cool. That makes sense. Thank you.
Yeah, the numbers are a little off. I think I screwed up something here, but you get the idea.
Yeah, I get it.
Yeah. Other questions?
I have a question about malpractice insurance.
Yes.
If your employer offers malpractice, then you don't really have a choice in like whether you pick occurrence or claim base. Is that correct?
So, malpractice obviously costs money, right? So the employer will choose to either have occurrence based or claims made. So tail or we'll say tail or no tail, right? And so usually it'll be uniform for all their employees. So you can have a policy that's no tail, and when you leave, you're going to have to pay for it, basically.
Okay. So we still have like.
So that could be a potential negotiating point. Mm-hmm.
I see. Okay.
But in general, most of these employers will have, they wouldn't want to pay for tail coverage up front. So they'll pay for claims made the whole time that you're employed with them. And if you leave, if your contract says that we'll cover the tail, then they'll pay for the tail at that point in time.
Okay.
Any other questions? Karen, this is your first time through, right? I think a lot of, and some of the rest of you also, this is your first time through. So, everything clear?
Yes, thank you.
Sure. Okay. So you can reach me, obviously, email, text. I think most of you have my number. So next time we're going to talk a little bit about cash flow and budgets. We're going to talk about debt management and savings rate, how to create an appropriate savings rate, and what makes people happy with regards to money and how they spend money. Okay. All right, guys. So have a good night. Thanks for joining. And I'll see you guys soon.
Thank you,
Thank
Dr.
you.
Kennedy.
Thank you.
Okay.